Okay, let's start the class. Good morning once again. Sorry for the delay in commencements. I just believe that we needed to wait for people to join. So now we have a reasonable number of students in the class, then we can start. So in the last class with you, we're looking at capital allowance. We looked at capital allowance. So where we said capital allowance granted by a taxpayer to granted to a taxpayer by the tax authority. Capital allowance is the allowance granted by the tax authority to a taxpayer that incurs qualifying capital expenditure for in a particular year, in a particular year, and puts same into production use at the end of the basis period. So we discussed that. So in my last class, we spoke about the condition for capital allowance. I said ownership must not be in doubt. Ownership. I said asset must be used for the purpose of generating tangible income. I said application is required. I said it must be used throughout the year, so no temporary disuse. And we said where the value is more than 500K, the taxpayer must apply. So we have discussed all that in my last class. Today, in my last class also, we spoke about types of capital allowance. I told you basically we have the initial allowance and the annual allowance. So we said initial allowance is an allowance granted to the taxpayer once throughout the useful life of the assets. In my last class with you, I told you deliberately that qualifying capital expenditure is synonymous to fixed assets. But in my last class with you, I quickly gave you the difference between fixed asset and qualifying capital expenditure by saying that not all the assets will qualify for capital allowance. And by so saying, I said that take, for example, land. Because of the limitless life of the assets, then it cannot be categorized as QC. Okay, that was what we discussed in my last class with you. Now, having said that, how do you calculate your initial allowance? Initial allowance is calculated as costs multiplied by the initial allowance rate. So the initial allowance rate and annual allowance rate shall be given in the exam. So you do not need to cram the rate because it's going to be given to you in the exam. Now, I will say this. So take for example, a motor vehicle was acquired. For example, a motor vehicle was acquired and the cost is 500,000. Okay, so the initial allowance rate for motor vehicle is 50%. Therefore, to get my initial allowance, I will say 50% multiplied by 500,000, and we have 250,000. One thing that you should note is that initial allowance is not prorated. Initial allowance, if an asset is acquired, if an asset is acquired uh, even on the last day of the sorry, even if the last day of the basis period, the assets will still enjoy full annual allowance. The asset will still enjoy full annual initial allowance rather. So you have to take much of that. You have to take so if that is the case, we should be done with initial allowance. Any question for initial allowance? Okay. If there is no question for initial allowance, move on to the next one. Uh, Today, Femi was the first person to join the class. Femi, good morning. I saw Mr. Hussein too joined. We did the first four people. Mr. Hussein, good morning. I'll start from the beginning.
Good morning, sir.
Good morning, Mr. Hussein. Adebayo Ahmed, good morning. Clement, good morning. David, good morning. Vincent, good morning. Etima, good morning. Fatima, good morning. Femi, I greet you again. Benga, just I greet you again. Mr. Hussein, I greet you again. Ife, I greet you specially. Jackson, I greet you again. Kenny, I greet you. Laura, I greet you. Mike, I greet you. Sharafa Mustafa, I greet you. And Usman, okay, let's go ahead. So today we go back to our annual allowance discussion. Annual allowance. Annual allowance. So annual allowance is an allowance granted to the taxpayer that incurs qualifying capital expenditure throughout the useful life of the assets. So what are the characteristics of this? This is prorated to the number of months in which the assets will be put into production use. It's very important to know that. So that is that. So you must note that. So it is prorated to the number of months in which the assets will be put into production use at the end of the basis period. Okay. Having understood that, how do we calculate annual allowance? How is annual allowance being calculated? Annual allowance is being calculated as follows. Annual allowance is calculated as follows. So, for example, when you say annual allowance, it's going to be cost minus initial allowance divided by number of years. Cost minus initial allowance divided by number of years. How do you calculate your N? Your N is 100% divided by annual allowance rates. So if your annual allowance rate in percentage is 25%, N will be 4 years. If your annual allowance rate is 20%, N will be 5 years. If an annual allowance rate is 10%, N will be what, everybody? N will be what? N will be 10 years. Okay. N will be 10 years. So having understood that, that is, this method or this formula is used when the basis period is equal to 12 months. AA is equal to cost minus initial allowance divided by N multiplied by Y over 12, where Y represents the number of months within the basis the case. That means we use this method where the basis period is less than 12 months. The basis period is used where the method is used where the basis period is less than. Now, let's use the first example to do that. You will set motor vehicle was acquired for 500 million, 500,000. Calculate the annual allowance. To do that, I will say cost 500,000 minus initial allowance 250,000. Annual allowance rates for motor vehicle is 25%. So how many years did that asset use? How many years?
4 years.
4 years.
So divided by 4, I would have 62,500. Confirm that number. Or 120, no, 62,500. Is that number correct? So that will be your annual allowance. So in a simple form, let's go to tabular. So we said the answer we use 4 years. So year 1, your cost is 500,000. Your initial allowance is 250. Your annual allowance is 62,500. What is my tax written down value? So what do you call tax written down value? Tax written down value is equal to the initial allowance annual allowance. So give me a value. What do you have? Please press your calculator. Don't go to class with that. What do you have? What do you have? Why are you not talking now?
One is 7,500.
One. 187,500.
In year 2, thank you, Mr. Hussein. In year 2, that is my tax written down value. So the cost we said is become so like the asset. I'll bring it this one again. So my tax written value will now be 125,000. So year 3, AA is constant. 500. I'll have tax written down value 62,500. Year 4, annual allowance. Which your mark? So in year 4, which is the year of use, You remember we said it's costs. Okay, so in year two, you take now divide n minus s and that
Sorry,
is
sir.
already. Now,
Your audio is not
what
supposed
is
to.
the year one minus year one? Terminal value year will be terminal value year one minus annual allowance two. My audio is not working. Hello? Nobody.
Yes, sir.
It was
The
breaking
audio is
before.
not.
Hello?
The audio was breaking before. The communication was not as in you were not really audible. So it was breaking, cracking, and all that.
Okay, but now go.
Now it's better.
We praise the Lord. Oh, so sorry. Let's continue. Leave my board. They have started. No. They have started rolling on the board. You don't distract my board. Just leave the board alone for me. The board belongs to teacher. So I was saying your annual allowance is calculated like this. And I now said in year two and subsequent years, your annual allowance is computed like this. Now notes for each of the assets, they have different computation of annual allowance. You don't match them together. This is what I am saying. If I acquire furniture today and I also acquire land, building, I also acquire building, I will calculate their annual allowance separately. So what I am also saying the other time is that I want to show you the relationship between tax return computation. So tax return one will be costs minus initial allowance minus annual allowance. This is assumed to be a particular asset. For one asset, you do it for all the assets. In the second year, my tax return value one, my minus my annual allowance one. This is one minus my allowance two rather two. Year three. Year three will be my tax return value two minus my annual allowance three. Minus my annual allowance three. Year four will be my tax return value three minus my annual allowance four. Now, in the last year of use, my tax return value in the last year of use, which is N, will be my tax return value N minus 1 minus tax annual allowance N. So, again, in my last year of use, my annual allowance or my terminal value N must equal to my annual allowance N. Okay. Again, in my last year of use, my annual allowance will equal to my terminal value N minus 1 minus 10 naira. Let's explain. This means every asset that we acquire, you must retain 10 naira on the assets. Therefore, I will call that value residual value scrap value or nominal value. So these are the three. So it's the same thing. So at every point in time, when the asset gets to the last year of use, you must retain 10 naira. So indirectly, by the time you calculate your annual allowance in the last year of use, I'm now saying you remove 10 naira. That means this 10 naira will be your residual value until the asset is disposed. So this is the last year of use of these assets. Just as I've explained here, I must retain 10 naira. So 62,490. Terminal value, which is the last year, will now be 10 naira. You must retain 10 naira. But what did you notice in this? You will notice that our annual allowance is constant. Annual allowance is constant, except for the last year of use, where we had to retain 10 naira. You must, at every point in time, retain 10 naira. Okay? So that is that. Now, having said this, we will quickly move to a scenario where the basis period is less than 12 months. Where the basis period is less than 12 months, let's say, for example, an asset, let's say uh, a motor vehicle was acquired on 1/4/2022 and the company commenced operations on 1/7/2022 with an accounting date of 30th/9 annually. The costs of the vehicle was 50 million required. One, compute the capital allowance for all the useful life of the assets. Two, what is the tax implication of assets acquired prior to the date of commencement. So I'll start from the second one. Any assets acquired prior to the date of commencement, any assets acquired prior to the dates of commencement shall be deemed to be acquired on the date of commencement. Okay, so if I acquire an asset prior to the date of commencement, the asset is deemed to have been acquired on the date of commencement. Therefore, this equipment that was acquired on 1/4/2002 will be deemed to have been acquired on 1/7/2002. That is number one. Now, I would understood that. We move straight to the next. He disappeared. Maris, you are new in this class. Introduce yourself. Maris, we are waiting for you. Okay. Let's go ahead. I can see some new people joining this class. Maris, introduce yourself, please. I don't know you. Is Maris in this class? As well, you. Okay, let's go ahead. So, if that is the case, so we said any asset acquired prior to the date of commencement will be deemed to have been acquired on the date of commencement. Therefore, the equipment is deemed to have been acquired on the date of commencement. It is deemed to have been acquired on the date of commencement. Okay. So the next thing that we need to focus on is we need to understand when a company commences operation and how is the company being assessed with tax. Now, it is clear that this guy commenced operation on 1/7/2022. So we have what we call basis period for asset allocation. So basis period under capital allowance is mainly for asset allocation. But before that, we need to go back to our basis period rule. When the company commences operation, we said the company will be assessed with tax from the date of commencement to the end of the first accounting year end. That will be 30/9/2022. When would this be assessed with tax? Who can tell me when this will be assessed with tax? Who can tell me? 2023. So we said the next accounting year will be from a day immediately after the end of the accounting year to the end of the second accounting year, 2024. Next, a day after that, $25. Next, a day after that, $26, and so on and so forth. Now, that first asset, that asset that was acquired, it will fall in this period because the acquisition date falls within the commencement date. Now, when you look at the commencement date in 2023, is our basis period up to 12 months? Is our base period up to 12 months? The answer is no. Our base period only commenced from 1/7/2022 to 30/9/2022. How many months is this? 7, 8, 9. So this is 3 months out of the 12 months that is supposed to be in the base period. By implication, it now means that if our basis period is less than 12 months, our annual allowance computation will change. It should now be cost minus initial allowance divided by n multiplied by y over 12. What does y represent? The number of months in the basis period in which the assets will be put into production use. So what would happen in the second year? I'll revert back to my method because the base period in that period is less than 12, is equal to 12 months rather. So that is what I would do. So again, in this question now, which of these am I using? Am I using this for the first year or using this? Which one am I using?
You're
Which
using
one
the
am
first,
I? I'm using the first one.
the one that has white.
So because our N is not up to 12 months, right? So let's go. Annual allowance will be before we calculate that allowance, we need to calculate our initial allowance. So that will be cost multiplied by initial allowance rates. So the cost of this asset is 15 million naira multiplied by the rate for motor vehicle or equipment is 50%. So that will be 750,000. You remember, I told you you do not prorate initial allowance. Now for our annual allowance will now be cost minus initial allowance divided by n multiplied by y over 12. Let's take it one after the other. So if that is the case, I will have 15 million. This is 7.5. This asset has annual allowance rates of 25%. So how many years would the asset use? 4 years. But unfortunately, the assets had used, we only used 3 months in that basis period. So I will now say 750K multiplied by 12, 3 over 12, and divided by 4. So what do you have when you calculate your answer? What do you have?
46,875. That's 40. Okay.
Okay, this is 5 million. That's 1.5 million. Check it out.
First is the 750. 468, 750.
Okay, Alaja, thank you. 468,750. This is your annual allowance. So let's go to our table. In my table, I have costs 15 million. Initial allowance 7.5. Annual allowance 468,750. If I subtract that, I have taken down value. Give me my value. Give my value. What do you have?
281,250.
Okay. It's not possible. What is my annual allowance? Someone else should tell me. This is 7.5 million. This is 487, 468, 750.
It's 731,000.
31,250 naira.
What are you adding? Fill this to them. Eh? Why are you adding it together? Is it not subtract? What do you have?
7 million,
It's
31,250.
31,250.
7 million.
31,250.
So in the second year, what would happen? We revert back to our normal calculation. So cost minus initial allowance divided by n, because the basis period here will be up to 12 months. So what do you have? What's my cost? 15 million minus 750 divided by how many
4.
years? 4 years.
4.
Give me my value.
Size 1,875,000 naira.
1,875,000.
570.
Like this.
Yes.
Yes, sir.
So tax down value, give a tax down value. What do you have?
Million,
So
5,156,250.
AA,
150.
156, sir. 5,156,000.
AA is constant. What do you have?
3,281,250.
3,200,000 and
250.
no 3,000,000 two what? Give value now.
200.
I can't hear.
3,281,250 naira.
Thank you.
Yes, sir.
So this is supposedly the last year of the assets because the asset is supposed to use 4 years. Year 1, year 2, year 3. In the last year of use, your annual allowance is equal to your terminal value, but you remove 10 naira. Do you understand? So that's how to calculate annual allowance. Now, let's go. Let's look at another subhead that you need. Balancing adjustment. Who is that person? Who is that person? Mr. Hussein, mute your mic. So, balancing adjustments is the next one that we're going to be looking at. After that, we are now going to do a comprehensive question that has everything that we need. Okay? But before that, let's look at what balancing adjustments is talking about. What balancing adjustments is talking about. Now, when an asset is disposed, in our trading profit and loss adjustments, any profit or loss made on disposal is not taxable, not taxable, not allowable. Okay? Now, what is the compensation for this in tax? If you dispose an asset and profit is made on that, the profit that is not taxable. However, the balancing adjustment would work that out for you. So, two types of balancing adjustment that we have balance. Okay, I'm back. Sorry about that. Let's continue. I was explaining balancing adjustments where I said when an asset is disposed, it is either the company makes profit on disposal or loss on such disposal. Now, when a company makes profit on disposal, we said the profit is not taxable. However, there is a relief for loss, even though the loss is not allowed for the purpose of deduction. The loss is not allowed, and the profit is not taxable. However, when we have a profit situation, we call that balancing charge. When we have a loss situation, we call that balancing allowance. So what is balancing charge? Balancing charge will arise in a situation where sales proceed exceed the taxable value at disposal, where the sales proceed exceed taxable value at disposal. Therefore, let's say, for example, an asset was disposed for disposal value 10 million. Taxable value at disposal 3 million. Cost of acquisition 7,500,000. So, how do you calculate your balancing charge? Your balancing charge will be your disposal value 10 million less your taxable value at disposal, not the costs. So 3 million. And now we have 7 million as our balancing charge. Okay, so 7 million as balancing charge. However, there is restriction rule. What is the restriction rule? The restriction rule says that balancing charge cannot be more than the total capital allowance on the assets disposed. So therefore, if that is more, what do you do? If it is more, if it is more than the total allowance claimed on the assets, total allowance claimed on the assets disposed restricts to total allowance. So, therefore, how do you calculate total allowance on assets disposed? Total allowance shall be your cost price what's our cost price? 7.5 million less taxable value at disposal. 3 million. The maximum you can claim that the tax authority can charge rather is tax authority can charge is 4.5. A question will now arise from you. You will now say, what would happen to the difference between this 7.5 and the 4 million, which is 2.5? Which is 2.5. What would happen to that? The 2.5 shall be subject to tax, shall be subjected to capital gains tax. Now, what do I mean? You remember when Mr. Idris was teaching you capital gains tax? He must have told you capital gains will arise in a situation where your sales proceed is greater than your cost of acquisition and other incidental costs. Abi? So my sales proceed in this regard is 10 million. My cost of acquisition is 7.5. My chargeable gain will be 3.5, which is the same 2.5. The same 2.5 we have here. Okay? So that is that. So that means for the purpose of company's income tax, your balancing charge shall be restricted to the total allowance claimed on the assets disposed. Okay? So that is that. Do you have any question?
Yeah, I have a question. Can you hear
I'm
me?
with you.
Okay.
I just said go ahead.
Yes. The first calculation where we have 7.5 and then 3 million or something, then we get 4.5. Where is the 2.5 that is equals to this capital allowance charge? I want to get to know where you get that 2.5 here.
If you say, I am saying that the question you ask is that when I said capital allowance cannot be more than the total allowance claimed on the assets.
Yes.
And I said, how do you get total allowance claimed on the assets? Your total
Okay.
allowance claimed on the asset will be costs less tax now value at disposal. You have 7.5.
Yes.
But don't forget that when we were discussing balancing charge, as balancing charge is your sales proceed minus your taxes in our value.
Yes.
So you did that, you got this 7 million. We now said you cannot charge tax on 7 million. You have to restrict to the total allowance claimed on the asset. What is total allowance claimed on the asset? 4.5. We now said, okay, if that is the case, if it is 4.5, what would happen to the excess of 7 million and 4.5?
Okay.
And I said that will be subjected to what? Capital gains tax. And I'll refer you back to your capital gains tax. That how do you calculate your capital gains tax? Your capital gains tax will be calculated by you saying your sale proceed minus your cost of acquisition and other incidental costs. When we did that, we got 2.5, which is the same 2.5 that this guy had been exempted for in your company income tax. But
Okay.
I'm now saying that income shall be subject to tax under capital gains tax.
Okay. Understood now.
Yeah. Any other question? Move on to the next one. Okay, in the absence of none, we'll move on to the next question. Or the next subject, balancing allowance. Balance allowance shall arise where the seat is less than taxes in at disposal. Let us assume the sales proceed is 10 million. Terminal value at disposal is 15 million. Calculate your balancing allowance. You see sales proceed 10 million. Terminal value at disposal 15 million. Balancing allowance will be 5 million. Okay. Does balancing allowance has restriction? The answer is no. There is no restriction for balancing allowance because balancing allowance is an additional allowance. Additional allowance to capital allowance claimable by the taxpayer. Okay, so that is that. Claimable by the taxpayer. Before we go ahead, let's see your question in your study pack. Go to page 236 in your study pack. Your study pack, page 236. So let's look at question number 2. No, don't put that cell down. Okay. Before we do that question, let's look at tax implication of assets
I'm always
acquired on second hand basis. There's one of you guys that joined from Canada. Is a guy in class? I don't think he's in class. Okay. The video of this class will be shared during the week. So ensure that you read and watch the video. Okay, let's go ahead. What is the tax implication of asset acquired on second-hand basis? The first one, we will talk about building. When building is acquired on second-hand basis, the following are the position of the acts. No initial allowance will be granted. For those of you that you have my textbook, you will see all this process there. No initial allowance will be granted. The annual allowance to be granted shall be on the lower of original cost of the assets and two, new purchase price. Lower of the original cost of the assets and two, the new purchase price. So if the assets is building, this is a position. Other assets. Where other assets are acquired on second-hand basis, no initial allowance will be granted. Annual allowance to be granted shall be on taxing down value or on the unexpired useful life of the assets. Shall be on the unexpired useful life of the assets. Okay? So that is that. Any question? This principle must be known by acts. By acts, rather. Your acts must know the principle. Okay, let's look at question number 2. We can now do question number 2. Having understood all the principles that you need to know in capital allowance. Question number 2. Someone should read for us, please. Page 241. I want a fine voice, so I don't want all these cracky voice from the guys. Sweet voice from the sweet ladies in the class. Oh yeah, ladies in the class, over to you. You take charge now. You see them, when we have given them chance, they have not taken charge. When my guys now take charge, now they will not be complaining. Ladies, over to you. My guys, over to you. Okay, I want to assume that's the end of the class because nobody is ready to read the question. Okay, we'll see again next class. Assignment, question number 2, go and solve it. Good day to you. Okay, let's continue. Please, let's make this class interactive. I don't like a situation whereby I'll be in class, I'll be calling your names, you will not answer, you will not participate. That is not how to do this lecture. This is online class, and in online class, it has to be interactive so that you will not just be in class without anybody talking to me. Please, I can't be teaching that way. That's not the way to go about it. I'll read the question and that'll be it. Well, it's so unfortunate.
Thank you, sir. Don't be annoyed.
No problem.
Please, someone should help us share the material, please.
It is in your group. That material was shared yesterday again in your group. We'll go share this yesterday.
Okay, sir. Okay.
Just hold on. I'm trying to adjust my screen. Just hold on. If I can do that, I'll read.
I want to read it myself. If you like,
Okay.
don't listen.
Okay.
And the mama call you then in down. Then you put out your man be a question on. I'm reading the question myself. So if that is the way you want to do it, I'll read my question myself. Question number 2. It will not just be good that we are in class, you are not making me happy. I can't be in class and just keep quiet.
Okay. It's noted. Subsequently, we'll make you happy. Sorry.
I'm with you, guy, my brother. What they want to class are that question. I was still sleeping. That she share by body concept and question. Okay. Question number 2. Page 241 thereabouts. For your information, capital allowance is always question number 1 with company income tax. So always ensure that you understand it. If you don't understand it, it's a problem. If you get a company income tax, if you don't understand this topic, it's a problem. Okay. I'm reading the question. Pedro, before that, let me make sure people know to be able to. Okay. Pedro Nigeria Limited is a manufacturer of polythene. Before we go, another thing I need to tell you is that there is restriction of capital allowance itself. Capital allowance. Now, what are these restrictions? What are these restrictions? Please put your mic, Benga. Number 1 restriction is that if a company is a trading company, the capital allowance of this trading company shall be restricted to 66 to 3% of accessible profit. What are trading companies? All companies in Nigeria, except for manufacturing company and agricultural company. All of them are going to restrict the capital allowance. Number two, agricultural company, and manufacturing companies. There is no restriction to the capital allowance to be granted to the taxpayer. So by implication, the taxpayers will not have to restrict the capital allowance. Why is government doing this? Government is doing it to encourage investment in agricultural businesses and manufacturing businesses. Okay, so that is that. So any asset they acquire, if they need to claim capital allowance, they can claim capital allowance to the fullest without any restriction. So that is the implication of that. So let's go. So we said Prado Nigeria Limited is a manufacturer of polythene bags. It was incorporated on date of incorporation. What is 1/1/2018? But commence business date of commencement. Date of commencement 1/3/2020. I have told you severally that date of incorporation is not the same as date of commencement. Date of incorporation is not the same as date of commencement. Date of incorporation is not recognized in tax. It is only date of commencement. Therefore, this company commenced operation in 2020. The following is the summary of its adjusted profit for the respective years. Period 2. What is period 2 in commencement? When you see period 2 in commencement, what does that mean? Who is helping us out? When you see period 2 in commencement, what does that mean?
Less than 12 months or more than 12 months.
Thank you, Alaja. It's a period that is either more than or less than 12 months, right? That was what I taught you. But when you see it in commencement, it means from the date the company commenced operation to the date they gave you the question. So in this regard, they said period to 31st 12/2020. Abi? So that means from the date this company commenced operation 1/3/2020 to this date. Okay, that's what that means. Okay, they gave us profit for all those periods, and they now told us that some assets are were acquired rather. So the first asset was acquired on April 5, 2020. What is it? Okay, on April 5, 2020. So that falls within that. The other one was acquired January 17, 2021. The other one, December 1, 2021. The other one, January 3rd, 2021. Now, the company sold some of its assets on 31st December 2024 as follows. As a newly appointed tax consultant of the company, the managing director sought your advice on both capital allowance of the company and the liabilities resulting thereof for the year ended for the relevant years. It, however, informed you during the time of finalizing the engagement that the factory building was purchased on second-hand basis from a company that ceased operation 6 months earlier, who acquired the building at the cost of 7 million. That is what original cost and the new purchase price. You are required compute the capital allowance for the relevant years and the tax liability. So, what do we do? You should note that there is difference between the way you compute depreciation and capital allowance. Okay? There is a difference between that. Now, what does this mean? What does this mean? Look at this asset that was acquired on April 5. Okay, let me use an hypothetical scenario. Let us assume an asset was acquired on May 10, 2022. If you want to calculate your depreciation, you say year 2022. This asset will use how many years, how many months rather, in this financial year? It will use May, June, July, August, September. In fact, June, July, August, September, October, November, December, 7 months. Plus how many days? From 10, that is 10, 11, 12. That is plus 21 days in the month of May. So this is what you will use to calculate your depreciation. But for capital allowance, provided the asset you acquire falls within the basis period, the assets will enjoy full annual allowance. Unlike this one that you are prorating depreciation, you will not prorate the annual allowance, because if the asset falls in a base period that has 12 months, then irrespective of when the asset was acquired, if they like, let them acquire the asset on the last day of the accounting year. The assets will enjoy full depreciation, full capital allowance, rather. So that is different. Now, what is the procedure for computation? The first thing that you need to do is to identify the asset and look at the years in which they are going to be introduced for the purpose of capital allowance in our question. So, what is the name of this company? Prado. Nigeria Limited, right? Preparation. The first thing you prepare, preparation of assets allocation schedule. Now, when this company commence operation? The company commence operation when? June, May, March, right? So I will say March. That is from 1/3/2020 to 31st/12/2020. The accounting year of this company is 31st/12/2020. 31st December annually. Therefore, this will be introduced 2021. For 2021 to now, if you are given a question like this, what you use to determine the relevance here is the profit that you are given. Where profit is not given, you will use the last assets acquired by the company to determine the relevance here. In this regard, profit was given, and the last profit that was given ended December 2024. Therefore, that will be assessed to tax in 2025. For the year ended 2020 to 2025, years of assessment. So, tax years, basis period, QC. So, in 2021, from 1/3/2020 to 31st/12/2020. From 1/1/2021 to 31st/12/2020. 2023, from 1/1/2022 to 31st/12/2022. 2024, 1/1/2023, 2025, 1/2024. Now, the purpose of this is for you to be able to allocate your assets to the relevant year of assessment. It's for you to be able to allocate your assets to the relevant year of assessment. Therefore, let's go. Now, the first asset was acquired when? When was it acquired? When was the first asset acquired?
I think it's April 5.
April 5.
Yes.
So if you look at your basis period, where would that fall? Would it fall in the first or second or third or fifth, fourth?
It fall on the 2021 tax year.
Thank you. So I'll bring that asset there. Factory building. The next one, where will it fall?
2021. It will fall 2022 tax year.
Office furniture. The next one, where will it fall?
Same place.
It's the only one in class, Abby. No problem. Continue. The next one, where will it fall?
Sorry, this question is on page what? Sorry, sir.
The next question is on page what? The next asset will fall where?
2022 tax year. Sorry, 2023 tax year.
So production plants. Okay, so no acquisition was done this year. When you go to the additional information, they said the company sold some of the assets in 2024. Abi, as at 31st December 2024, what are the assets is disposed? Disposal now. Office,
building.
thank you, Jerry. Office building, office furniture was disposed. Abi, and what
Yes,
asset was
January
also
20.
disposed?
Motor vehicle.
No. Are you following the
Plants.
question?
Production plants.
Production plants. Production plants. Okay. So these two were disposal. Okay. There was nothing happened in 2024 tax year. So that is that. Now we now know where to introduce the assets for the purpose of capital allowance. So I will start. What is the name of this company again? Prado. Prado.
Pardo.
Prado.
Prado.
Nigeria Limited.
Pardo.
Okay. Me, I dey see Prado. Sorry. So computation. Capital allowance for 2021 to 2025 year of assessments. How many assets do we have? Some of you cannot draw straight line. You are used to do bad thing. How many assets do we have? 1, 2, 3, 4. 4 assets. 1, 2, 3. The next one, 4. Capital allowance. So QC rates. Examiner will give you this rate. What's the first asset? First asset is factory building. Initial allowance, annual allowance, 10%, sorry, 15%, 10%. That's rates. Furniture, 25%, 20%. The next one,
Motor vehicle.
50%, 25%. The next asset, production plants, 50, 25%. And this will be capital allowance. So, year 1, 2020. Costs. What is the cost of the asset we acquired in 2021?
5.4 million.
Thank you, Daria Alaja. $5.4. Did we acquire any asset this year? No. So on that asset that we just acquired, we'll calculate initial allowance 15%. But note, the examiner says something on these assets. The examiner says something on these assets. Additional information number. Where is that? I saw it.
Should be the second paragraph.
Yes. He, however, informed you during the time of finalizing the engagement that the factory building was purchased second-hand basis from a company that had ceased 6 months earlier, who acquired the building. Okay? Do you understand me? So they acquire it for 7 million. And you remember the rules. When a building is acquired on second-hand basis, what are the rules? What are the rules? I will know if you are always writing or you're just in the class.
The
No.
lesson,
Asia.
the lesson of the first or the new purchasing price.
Okay, in this instance, which one are we choosing?
The cost.
The cost is 5.4, okay? And the new purchase price or the old one was 7 million. So that is not relevant. Now, what is the other condition? The other condition is that we have to calculate on annual allowance. That initial allowance is not relevant. So therefore, all I'm just going to do here is to divide this by 10. I'll divide this by 10 and multiply by how many months will this asset use in this month? From March to December, that is 10 months. I'll put my computation here. Annual allowance, factory building, costs, minus Odo, divided by what is the cost price?
5.4.
5.4. The asset is supposed to use 10 years. Okay? So ordinarily, whatever you get will have been the answer. If we don't need to prorate the basis period. If we don't need to prorate because of the basis period, I'll just divide by 12. But because the basis period is less than 12 months, I'll have to divide it. So that will now be 10 over 12. Bam, bam. So that will be, give my value. My annual allowance should be
450,000.
450.
Yes, for the first year.
For the first year. Elijah, thank you. 450,000 annual allowance. I'll bring it here. 450,000. I'll close it. I'll come this way. In 2022, tax using now value. What is my tax using now value? There's no tax using now value for this one. But what's my tax using now value for that one?
This one is 4,950,000.
Okay. Costs. We have bought other ones, Abby. We bought
Yes.
furniture and bought motor vehicle in that year. So give me one furniture. How much is furniture?
Furniture is 2,750,000 naira.
Okay. What about the other one?
Motor vehicle is 4,500,000. 4.5.
Sorry.
4,500,000 naira.
Thank you. So on these new ones, we are going to calculate initial allowance. Initial allowance on furniture is 25%. Initial allowance on motor vehicle is 50%. So 50% of this is 225. What is 45? 25% of this of 2.750.
687,500.
687.
87,500.
Add the two together. What do you have? This and this.
We have 2,937,500.
Thank you, Alaja.
937,500.
Good. Annual allowance. Annual allowance. Now we will recalculate AA. Annual allowance will be 540. So AA 540. What about for factory? For factory, what is the cost of AA? 2 million minus 687. $687,500 divided by 5 years. The next one.
Sorry, sir.
Yes.
The annual allowance is 450, not 540.
Mr. Hussein, wake up. In the second year of use, we are not going to prorate. We prorated that one because the number of months in the base period is not up to 12 months. That's why we prorated that one.
Oh, sorry, sir.
You are welcome. The next one will be, what is your costs? 4.5 less 225 100 divided by 4 years. We are giving. The first one is what? What is the first one? Give me my value. Maybe for my next class, I'll bring you my calculator. So you guys are not talking.
Five sixty two 500.
What did you call it, Alaja?
562 500.
The second one.
No, this is for the second one.
That's for the second one, Abby. Okay.
Yes.
What about the first one?
$412,500.
What do you call it?
412,500. 412. 412.
Like this.
No, 412. I got 412,500.
Oh, okay. So we take that, look at our computation. The first one, 412,500. The second one is 562,500. Alaja, meet your mic. If you add all this annual allowance together, what will it give you? Add all the annual allowance together. What do you have?
1,515,000.
515,000. Add it together. What do you have?
You have 4,452,500.
4,452,500.
500.
Yeah, that's next one. Tax return value. Million was million value.
Hello, sir, can you hear me?
Yes. I'm back. What is my figure for tax return value? What do you have? What's my figure?
Like 4,410,000.
4,110,000. 410.
410. Yes, sir.
Thank you. What's the next one?
1,650,000.
What's the next one?
1,650,000. 687,500.
AA. Give my AA. AA is constant for all this, but they acquire any asset this year. They acquire production plants. They acquired production plants. So I'll bring in the cost of that. Costs. How much did they acquire the production plants? How much did we acquire that? We are just making this last, so we're very, very tired.
650,000.
650,000. On that new one, we'll calculate initial allowance. 50% of this is what? 325. Now, AA is constant. AA is constant. AA is constant. We calculate A for this new assets. So how should calculate A for that new asset? What do we have? A for the new assets. That is 650 minus this one divided by 4. What do you have?
81,250.
Thank you, Mr. Hussein. Add this to whatever you have there. 2024. Oh yeah, now give us the tax union value for 24. Give me the total of this. What do you have? 2024. Give my tax union value. I'm waiting. Alaja, give me figure. 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 Can anybody hear me?
Just hold on. Yes, sir, we are calculating it. Just hold on.
Okay.
3,870,000.
Which one?
First one.
For plant and
For plant.
machinery,
Do you have?
4,250.
It's possible. Someone else.
For factory building.
For what, Alaja?
Factory building.
Okay, what do you have?
3,870,000.
Who else?
Then for the annual allowance.
Annual
Total.
allowance is constant.
The total.
Okay, what do you have?
1 million. 596,250.
Please, Elijah, call it again. I'm sorry.
1 million.
5.
596.
596.
96.
250.
250.
Add it to this one. What do you have? This is still 25,000. What do you have? Who is that? Who's carrying my people?
That's
1,921,000.
259.
Okay. So A is constant. What do you have? Your use of all these assets. For this one is 56. 5 to 500. Give a taxing now value. My taxing now value.
Okay, I have 253,750.
Where are you? The phone. Factory furniture. What do you have?
1, 2, 3. 1 million.
I can hear you. 1 million
1
what?
million. 1,237,000.
500.
500.
Yeah, I've added that. This showdown, what do you have?
One million. 1,125,000.
Thank you.
The last one.
Mm-hmm.
243,750.
Okay. In 2025, which is the last year that we're going to do this one, so we'll call next class. Because in 2025, my taxing now value, give me taxing now for all these assets.
It's 3,330,000.
3,330,000.
Yes, sir.
Thank you. God bless. The next one.
825,000.
The next one.
We have 562,500.
The next one.
162,500.
1,600. Now,
160.
this is the last 160. AA. A is constant. But this guy, that's the last year of use of this guy. You must retain 10 naira.
Okay.
It's 162,500.
So I add everything. I have 1, 5, Mute your mic.
You go call him first, no?
Mr. Hussein, mute your mic. We know the chop egg. That's you now value. Give my value. This is the last year of use of this guy. I have retained 10 naira. This will be 1.8. This will be 81. 81 to 50. This is 4,150, 500. So that's what we'll stop. They said we should do to 2025. So what do you have for this one? Whatever you have there, you put where you put.
2,790,000.
Thank you, Alaja. 2,790,000. So that's the end of the capital allowance. When we come in the next class, we'll do the company income tax and the disposal, because the disposal in this question, we also look at that when we come in the next class. Please endeavor you copy this question or the solution. Let me leave it for you so that you can snap it, or someone should download this thing now. Abby, someone usually download this in class.
Yes, sir.
So download it and share so that you write it. So that when we come in the next class, you will have it. Good day to you. God bless you.
So I have a question, sir. I have a question.
Okay.
This pack, is it possible to get it in a hard form?
Go and print it now. We don't have it in that form in ourselves.
Okay. It's all right.
All right.
Thank you, sir.
All right, Alaja. Have a nice week ahead. Bye.
Okay, thank you, sir. See you next week.
Yeah.
Who is sharing it, please? Who is sharing the notes, the class notes, please? Hello? Hello?
Share it.
Hello?
It will be shared on the group.
Okay.
It will be shared on the group.
Okay, thank you.